Welcome back to Everything Financial Radio. I am your host, Dennis Tubbergen. We're chatting today with Mr. Peter Schiff. And Peter, always great to have you on the program. And you had mentioned in the last segment as we were chatting that really the Fed doesn't have any choice. You said they really shouldn't continue with the stimulus, but then you said they probably will continue. In fact, Bernanke has not taken even more stimulus off the table. You look at what's going on in Japan. Prime Minister Abe is printing money like a maniac, and we've seen maybe a bit of a beginning of interest rate spikes there. How does all this money printing end up? This can't have a happy ending, but what's the end game here?
No, well, it's massive inflation and eventually a complete collapse of these phony economies. I mean, that's what's going to happen. I mean, the Fed is going to lose control or is already losing control of the bond market. And that means that even though the Fed is trying to get interest rates down by buying bonds, it's failing because when they print money to buy bonds, they are creating inflation. They are debasing the dollar. And eventually, the bond buyers figure this out, and they don't want to buy. They don't want to hold the bonds that they own. And the problem is, even though the Fed is buying bonds, it's not buying enough bonds potentially to absorb all the selling that's going to come from the market, as well as the selling coming from the federal government itself. We run a huge deficit, and so the government, is borrowing, $70-80 billion a month. So if the Fed just buys $70 or $80 billion, all it's doing is absorbing the new issuance. What about all the selling coming from the bondholders that don't want to go down with the ship? So then the Fed gets into a situation where it has to print even more money to buy bonds, which makes bonds that much less attractive because now there's even more inflation. And all bonds is a future payment of dollars, and if the dollars are going to be worth less in the future because the Fed has to print so many of them to keep interest rates from rising, then bonds have less value. And, of course, as the economy goes into recession, as the budget deficits worsen, as interest rates rise, that only accelerates the process. And, of course, if the Fed is concentrating its firepower on treasuries, what about mortgages? Mortgage rates rise. Now it's got to buy mortgages too. Well, how does it buy mortgages and treasuries? And then what if municipal bond rates start to rise and the states are going bankrupt? Is it going to buy muni bonds? What about corporate bonds? What if corporate bonds start rising and corporations can't afford to pay? Is the Fed going to start monetizing corporate debt? And then what if some banks start to fail? Is the Fed going to monetize all that? I mean, so there's a limit to how much they can print before you set off a hyperinflation. So at some point, the Fed has to concede that they can't do it anymore, and then all the problems that they have been holding at bay and postponing are going to come home to roost, and it's going to be a much bigger crisis than what we would have experienced had the Fed not postponed it for so long and just simply done the right thing sooner.
So, Peter, does that mean that when the Fed finally throws in the towel, because it seems to me that from my research, debt levels are so high, there's not enough money on the planet to probably backstop all the debt that's out there. Does that mean then we do see a deflationary time frame, in your opinion, similar to what we saw in the 30s?
No. We're never going to see that. We're not on a gold standard anymore. We don't have real money. So I think that in order to see the deflation, you're going to have to look at it through the prism of gold. And even though gold is falling right now, I believe you will see a massive deflation in terms of gold, where the price of everything will go down in terms of gold. But if you try to price things in terms of paper money, I think you're going to see prices rising. And I certainly think, though, you can look at relative prices, and I think the price of real estate, the price of stocks, particularly in America, on a relative basis is going to go down a lot compared to the price of food, right? The price of energy. So there you can see a deflation of assets, where asset prices go down relative to the price of consumer goods, which is all a recipe for a lower standard of living, because our wealth goes away and our cost of living goes up. So the value of what we own goes down, but the price of what we need to buy to live goes up. And that's what's coming.
So Peter, you mentioned gold and measuring, using gold as a metric versus U.S. dollars certainly makes sense. In fact, we often on this program talk about the Dow priced in gold. But let me ask you, given the current significant decline in gold, what is your forecast for gold?
Well, I mean, I think gold's going to decline until it reverses, right? And then it's going to go way up. I don't know how much more it can go down. I mean, obviously it can. So I'm not going to say gold can't go to 1,000 or can't go below that. But if it does, it's not going to stay there. That's the point. It can't stay there. I mean, most mines can't even produce it profitably at 1,200. So a commodity can't stay below its cost of production very long because then there's no more production, there's no more supply, and so the price goes way up. So the price can't stay at these levels. I think it's going to go much, much higher. I just don't know exactly when it's going to turn around, but I'm confident that it will turn around. And when it does, I think it's going to be a huge rally. And I don't think there's going to be a lot of supply forthcoming because gold mines are already shutting down. They're laying off workers. They're taking, they're canceling their capex, their exploration budgets. And if gold in the next few months turns around and goes back up to 15, 16, 1700, they're not going to bring all those projects back on stream. So you're not going to get extra supply as the price goes up, and so I think the price can go up even faster in the next leg of the bull market than it did in the last leg.
So, Peter, when you look at the country of China, it appears that China has been not only producing but importing massive levels of gold. China has made it a stated policy goal to have their currency achieve reserve status. Are we seeing the beginning of the next currency tied to gold in the Chinese renminbi? Is that China's long-term plan, and will that finally make everyone using all this paper money be honest again?
Well, I don't know what China's long-term plan is. They haven't confided in me. But I think if that is the plan, it would be a smart one. I mean, they should be trying to back their currency with gold. They hardly have any gold reserves right now. They're obviously trying to increase the percentage of gold in their reserves because they are the world's biggest producer of gold. But they don't export any of it. In fact, they import gold. It would be like Saudi Arabia importing oil. So obviously they're doing something with that gold, and it's not just the Chinese government that is holding on to gold. It's the Chinese people that have been big buyers of gold, and I expect that to continue.
So let's talk a little bit about your forecast for various asset classes. What are you advising your clients now when it comes to U.S. equities?
Well, we're underweight U.S. equities. I mean, I prefer global equities. I mean, we have some exposure to the U.S. market, particularly to export-type companies. But we are more focused in foreign markets, which have performed, not performed as well as the U.S. market over the past year or so. But I think over longer time horizons, they've done better than the U.S., and I think they'll do considerably better, in the future. I think the recent performance is more of an aberration. I think there's a false confidence that the U.S. economy is recovering, and again, as I said earlier, it's not. So I think U.S. stocks are going to underperform many of the markets that we're investing in around the world. And particularly a lot of the resource names that have been just really beaten up. I mean, we've had bear markets, huge bear markets in the mining stocks. And so, in fact, I'm so optimistic about the mining stocks that I'm launching my first gold mining mutual fund next month. I've never had one. We run about 8 mutual funds. And my first gold fund is going to be launched next month. I just think it's the best buying opportunity I've seen. Does that mean the market's at the lows? No, I don't know where the lows are, but I think they're really low compared to where they're going to be.
So, Peter, you mentioned foreign equities. Can you share with the listeners some of the bright spots economically around the world, assuming they exist?
Yeah, well, I don't think that necessarily they're not that bright right now. They're a little bit dim, but you need to see, how things are going to change. And I think that as the world takes a different view of the U.S. and as the world allows the dollar to fall, I think the Asian economies in particular are going to thrive because they won't be squandering their savings on treasuries. They won't be exporting their production to people that can't afford to pay for it. It doesn't make sense for China, for example, to export so much to the United States when their own citizens are lacking the products that they're exporting. I mean, you export in order to import, but if America is not producing anything the Chinese want to import, then it's a waste of their resources to loan us the money to buy what they produce. They should just consume what they produce, and they will when the RMB rises. And I think when Asian currencies in general appreciate significantly against the dollar, that will set off real economic booms in these countries. And so I'm optimistic long-term on the countries that are doing it right. I mean, they're making some mistakes, like printing a lot of money to buy dollars, but their people are working, they're producing, they're exporting, they're saving, and they have less government, they have fewer regulations and taxes than we do. They don't have populations expecting to live on Social Security, Medicare, disability, welfare. So I think those countries are going to do better, and I want to invest there. And, if individuals, your listeners, are interested, I mean, they should contact my company, Euro Pacific Capital, to find out about all the various markets and equities that we're investing in, the funds and the managed accounts that we offer that, that let people take advantage of these opportunities.
Peter, last question here. I want to talk a little bit about currencies because it seems that there is a worldwide race to the bottom as far as currency devaluation is concerned. You've talked about the dollar. Certainly, the Eurozone is in bad shape, full-blown depressions in Greece and Spain for sure. We talked about Japan briefly. How do you see all this playing out, and how does the U.S. dollar fit in? Does the yen fail, the euro fail, and everybody rush to the dollar? How does all this play out in your view?
Well, I think, unfortunately, the U.S. dollar is going to win this race to the bottom. I think as flawed as the euro is, or even the yen at this point, that the problems in the U.S. are even bigger, and therefore the problems for the dollar, even more acute. So I think the key is to avoid the dollar. But I also don't have yen or euros either. So, those are not the only three currencies on the planet. There are currencies that are in much better positions than either of those three major currencies. So those are the types of currencies that we own. And we own them for clients who want to buy bonds and equities. So I think it's important to have the right currencies. But of those three flawed currencies that are going to be debased, I think the dollar has the greatest problem. And right now, I would say the yen is number two, and I think the euro is actually in the best position of the three. And maybe that's Germany's plan. I mean, maybe they have an eye on the euro be acting as a reserve currency in place of the dollar. And I think that the Europeans are getting a lot of criticism now. But I don't think they're making as many mistakes as the Americans. I mean, they're making plenty of mistakes, believe me, and I have lots of criticism for the way Europe is handling this situation. But I think that we're handling our situation even worse. In the short run, it looks like we're doing better because we haven't dealt with any of our problems. We're just making them worse. We're taking more drugs, and they're at least talking about rehab. Even though they're not totally there, but I mean they're not at least drugging themselves to the degree that we are. But I think we've got a much more serious short-term problem looming on the horizon. And in fact, if you look at the euro, even with all this talk of the U.S. economy recovering, the dollar is actually trending down against the euro, not up.
Well, and that the charts do not lie. So our guest today has been Mr. Peter Schiff. Peter, we certainly appreciate you joining us today and hope you'll come back.
Oh, sure, anytime. And don't forget, I do my own radio show from 10 a.m. to noon Eastern Time. Every weekday, people can listen on SchiffRadio.com is on the internet site. My last name, Schiff, SCHIFF radio.com. And if you can't listen live, just tune in anytime during the day and you'll hear the show.
All right. Well, I'd encourage the listeners to do that. And Everything Financial Radio will return after these words. Stay with us.